Sir, very happy morning to all. I believe that your preparations are going very well, my dear lovable students. This is a small lecture to solve question number 1 from our mock test paper of direct tax, which is a compulsory question. And that's a 15-mark question. So I thought that 14 mark or 15 mark is very important for this exam. We will be trying question number 1. Sheetal Limited is a listed company located in Mumbai. It is engaged in multiple activities at different locations. Books of accounts are maintained by each unit separately. Head office maintains books relating to common transaction, like the branch account system they have given. All the accounts are consolidated and return of income is filed at Mumbai. So they are filing at head office. The following information is furnished unit-wise for the year ended 31st March 2024. Chemical manufacturing unit, Jaipur. So they are having one unit in Jaipur who are engaged in chemical manufacturing. Company has reported net profit of 300 lakhs in the books of accounts of the said business unit. So the net profit as per P&L account is 300 lakh. It mentored into an agreement for use of know-how owned by a renowned scientist. We know that know-how is an intangible asset entitled for 25%. But this is not owned by the company. They are paying royalty. Amount of royalty paid during the previous year 23-24 was total 40 lakhs. Total 40 lakhs they have debited to P&L account. Company deducted tax at source on the amount paid up to November 2023 and omitted to deduct tax at source on the royalty of 10 lakh due for the period from November to March 2024. That means out of 40 lakh, 30 lakh rupees they have deducted TDS, 10 lakh they have not deducted TDS. So 10 lakhs into 30%, 3 lakh should be added back. The payee admitted the royalty income fully, paid tax and filed his return of income before the due date specified in section 139 subsection 1. But the person to whom you have paid the royalty, he has considered that royalty as income, he has showed that in the return of income, and he has paid the tax also. But there is a twist. Current year anyway 30% disallowance will come. In the year in which he filed the return only deemed that TDS has been deducted. So current year we have to disallow 30%. And see, since he has declared that in the income in the next year, my dear lovable students, that can be claimed as deduction in our hands. Company has paid 33,60,000 being 15% of basic salary plus DA of the employee in the notified pension scheme, and the amount so paid is debited as expenditure in the books of accounts. We know that to 80 CCD only 10% is allowed, but 15% has been contributed. So 40A subsection 9 will be applicable. Whereas for that 10% you are entitled to claim deduction under 36. So when this business unit, chemical manufacturing unit Jaipur, all the adjustments we have discussed in the class, that too in PGBP, capital gain and IFOS lot. My dear lovable students, I am going to go through the answer. Computation of total income and tax liability of Sheetal for assessment year 24-25 under the regular provisions of the Act. This is regular provisions of the Act. Profits and gains of business or profession. Net profit from chemical manufacturing unit. Sir, this is manufacturing unit. Chemical manufacturing unit, Jaipur, 3 crores 300 lakhs they have given. Add items debited but to be disallowed. Royalty on which tax is not deducted. Please focus on the explanation. 30% of 10 lakh being payment of royalty without deduction of tax would be disallowed under 40A subsection 1A. Why sir 40A subsection 1A? Because it is to a resident. While computing the business income of assessment year 24-25. However, since the payee has admitted the income, point number 1, paid the tax, point number 2, and filed this return of income, point number 3, before due date, the same would be allowable in previous year 24-25. So next year that 30% can be claimed as deduction. Relevant to the assessment year 25-26 being the year in which tax was deducted and paid. So current year 30% disallowance is mandatory in nature. So 10 lakh into 30% comes to 3 lakh should be added back, and next year you can claim it as a deduction. Employer's contribution to notified pension scheme. As per 36 subsection 1 clause 4a, employer's contribution to the account of employee under the pension scheme referred under 80CCD would be allowed as deduction while computing business income only to the extent of 10% of salary and DA of the employee in the previous year. But instead of contributing 10%, employer has contributed 15%, so that extra should be added back as per 40A subsection 9, contribution to unrecognized fund. Therefore, so their calculation is 33,60,000 divided by 15 into 5, that extra 11,20,000 should be added back. So 11,20,000 representing the excess 5% debited to P&L account has to be added back while computing the business income. This add back is as per 40A subsection 9. They have mentioned only about the deduction part. They have not mentioned about the disallowance part. Actually, this section, as per this section only, we are adding back. So we have taken net profit as per P&L account. We have added the royalty on which TDS has not been deducted. So 3 crore plus 3 lakh, 3 crore 3 lakh plus 11,20,000 comes to 3 crore 14,20,000 is the net profit from the first business. Brilliant, sir. It's very easy part. Both has been discussed in the class. Furniture manufacturing unit Pune. I'm going to talk about the second business. Company has a manufacturing unit at Pune. It reports a net profit of 90 lakhs as per the books of accounts. So net profit as per P&L account is equal to 90 lakh. It bought a trademark, not I'm paying royalty, I bought. I bought means it is my asset. That is the difference between the first question and the second part. From Mr. Yellow for 25 lakhs on 1/6/2023, which is charged as expenditure in the books of accounts. This is wrong treatment because we have treated a capital expenditure as a revenue expenditure. So I should add back the entire 25 lakh. We know that know-how, patent, copyright, trademark, license, franchisee or any other assets of similar nature other than goodwill. We have to claim depreciation at the rate of 25%. Fantastic to the core. The unit paid 3 lakhs as interest on loan taken from non-resident Indian, NRI. The tax was deducted at source in March. Yes, during our previous year tax has been deducted. This is one of the important condition. But it was remitted only on 6/5, no problem, because it has been remitted before filing the return of income. So no disallowance is required for this part. What is the condition? During our previous year, TDS should be deducted. Company paid 7 lakhs, being the amount of income tax payable by employee on non-monetary perquisite provided by company. This amount is debited in the books of accounts as expenditure. We know that 40 small a series is there. In that 40A subsection 5 is saying that tax on non-monetary perquisite debited to P&L account should be added back. A very normal PGBP adjustment. Net profit from the furniture manufacturing unit Pune. Net profit has been given as 90 lakh. Add items debited but to be disallowed or to be treated separately. Trademark. The entire trademark expense we have debited to P&L account, which is a capital expenditure. Trademark is an intangible asset which is eligible for depreciation as per section 32. Since purchase cost of trademark has been debited to P&L, same has to be added back while computing business income. So 25 lakh should be added back. But for this 25 lakh, we can claim 25% depreciation. So 25 lakhs into 25% comes to 6,25,000. We can claim it as deduction. Less depreciation on trademark under section 32, 6,25,000. We can reduce it. Fine, fantastic to the core. So trademark is an intangible asset. Know-how, patent, copyright, trademark, which is eligible for depreciation as per section 32. Since purchase cost of trademark has been debited to P&L account, the same has to be added back while computing the business income. Fantastic to the core. Number 2, interest on loan taken from non-resident, no disallowance. Nothing has been required, my dear lovable students. Fine. No disallowance under 40A subsection 1. Why 1? Because for non-resident. Is attracted in respect of interest since the tax has been deducted during 23-24. That is a very important commission. And remitted on or before the due date of filing return of income for assessment year 24-25. Income tax paid on non-monetary perquisite as per 40A subsection 5. 40 small a series, tax paid by employer on non-monetary perquisite is not allowable as deduction since the same has been debited to P&L account, same has to be added back while computing business income, my dear lovable students. So I have to take the net profit as per P&L, which is 90 lakh. To that 90 lakh, we have to add back 25 lakh, the full intangible asset debited to P&L account, plus tax, income tax on non-monetary perquisite 7 lakhs. So we will be getting 1 crore 22 lakh. From that 1 crore 22 lakh, depreciation on trademark is allowed. So minus 6 lakh 25,000. Sir, 1 crore 15 lakh 75,000 is the profit from the next business. I am moving into the third business. Good. This is a very normal question. If you are thorough with profits and gains of business or profession, a 14 mark is a gift. But since the question is talking about 3-4 businesses, we may have a mental aversion that how to face this question. So since it is there in the mock 1, the same may be lifted for examination. Maybe. Why to take a risk? We will be clear with those concepts. Fertilizer producing unit, Narmada. Company established a fertilizer producing unit in Narmada, Gujarat, which became operation in July 2023. We know that fertilizer plant is a specified business under section 35 AD. If you eat in your home, if you sit in your home or hotel and if you eat the fertilizer, you have to go to the hospital. Then they will do the wafer cleaning, right? So in that fertilizer plant is there. It has acquired a land for 1 crore. We know that GIL, goodwill, instrument and land not entitled for deduction under 35 AD and put up a building for 2.5 crores and installed new plant and machinery for 3 crore. Net profit as per books of accounts of this unit is 220 lakhs. After deducting depreciation of building 25 lakh and plant and machinery of 45 lakh. So we have to add back both the depreciation and we can claim 100% deduction under section 35 AD. Shall we? Net profit from the fertilizer producing unit 2 crore 20 lakhs. Fine. Add items debited but to be disallowed or to be treated separately. Depreciation on building 25 lakh, on plant and machinery 45 lakh. So 25 plus 40 70 lakhs I should add back. As per section 35 AD, no deduction would be allowed under any other section in any previous year in respect of capital expenditure referred in section 35 AD. Hence depreciation on building and plant and machinery is not allowable as deduction and the same has to be added back. So that 70 lakhs has been added back. So 2 crore 20 lakh plus 70 lakhs, 2 crore 90 lakhs. Now we can claim deduction under section 35 AD excluding GIL, goodwill, instrument, land. Deduction under 35 AD, since fertilizer units commenced operation on or after 1/4/2011, it is a specified business eligible for 100% deduction under 35 AD in respect of capital expenditure. However, deduction is not available on expenditure incurred on acquisition of land because of GIL. Deduction under 35 AD is 5.5 crore, being 2.5 crore on building and 3 crore on plant and machinery. Since it is more beneficial the company to claim deduction under 35 AD, it is assumed that the company has opted to claim such deduction. That is only our assumption. So totally, sir, for land nothing can be claimed, my dear lovable students. For building we can claim 2.5 crore and for plant and machinery we can claim 3 crore. So totally 5.5 crore deduction the company is claiming, but they are having net profit of only 2.9 crores. So from 2.9 crores, if you minus 5.5 crore, you will end up with a loss of 2.6 crore, but we are having section 73A. As per section 73A, loss from specified business can be set off only against profit from specified business, otherwise it has to be carried forward for infinite period. As per 73A, loss from specified business under 35 AD can be set off only against profit from another specified business. Since there is no other specified business, such loss has to be carried forward for assessment year 25-26. With this, I am done with the third business also. I hope that you are feeling so much comfortable. Warehousing facility for storage of edible oil at Delhi. It established a warehousing facility for storage of edible oil on 1/8/2023. We know that edible oil is not a specified business. It made investing such as cost of land 2 crore not entitled for any deduction. Building 3 crore, we can claim depreciation under section 32 because edible oil specified business kadayadungiradhanaala 35 AD apply avadu, 32 da apply avadu. And plant and machinery new 5 crores. The net profit as per books without deducting depreciation was 70 lakhs. 5. So without deducting depreciation 70 lakhs, so we have to claim the depreciation. So net profit of warehousing facility for storage of edible oil at Delhi, total 70 lakhs. Less depreciation under section 32 on building 3 crore 10% 30 lakhs. Plant and machinery, sir, 5 crore 15% 75 lakh, total comes to 1 crore 5 lakhs. So my dear lovable students, from 70 lakh, if you reduce 1.05 crore, it will lead to a loss of 35 lakhs. But this loss is normal business loss, intra-head adjustment is possible. As per 70 subsection 1, business loss from one source is allowed to be set off from other source under the same head. So in the first business, you are having profit, that is from the Jaipur business, you are having profit of 3 crore 14 lakh 20,000. The number 2, the manufacturing unit Pune, you are having again profit of 1 crore 15 lakh 75,000. But since the third business is a specified business, that loss I cannot set off, I have to be carry forward. But the fourth business, my dear lovable students, I can, sir, set off, I end up with a loss. The warehousing facility for storage of edible oil minus 35 lakh loss. So if I add first 2 business profit and if I knock off the last business loss, I will be getting 3 crore 95 lakh 95,000. All the 4 business I have done. I am coming to the additional information. The company mobilized capital during the previous year 23-24 by public issue of shares. They have issued shares, Kandipa. This much big company, they need fund. The application money was kept in bank pending allotment of shares. Okay, fine. Since we know that Companies Act is saying that within this many days the shares has to be allotted, so they kept that money in the bank account. The interest income from the said deposit is 3,20,000 is credited to the general reserve account. During that time, they got some interest, that amount has been credited to general reserve account. Whether that is taxable or not is a question. My dear lovable students, add interest on share application money nil. That means it is not taxable. Why? The interest on share application money deposited in a bank is not liable to be taxed, as the deposit was not made for making any additional income but to comply with the statutory requirement. My intention of keeping the money in the bank account is not to earn interest income. My intention is to comply with the statutory provision. Hence, that amount should not be taxable. The interest accrued on such deposit is merely incidental. The interest is eligible for set off against share issue expenses. I will be having share issue expenses. No. Against that share issue expenses, I can knock off interest income. In the interest income, share issue expenses are minus pannikalam. Sir, right, sir. This is as per case law. They have even referred that case law also. Sri Rama Multi-Tech Limited case law. Supreme Court judgment, my dear. Sri Rama Multi-Tech Limited. Sri Rama Multi-Tech Limited. Fine. So we have knocked off that point also. Company declared interim dividend at 10% of the share capital being 40 lakhs in December 2023. It has 27% shareholding in ABC Incorporation, New York, from whom it received 56 lakhs as dividend in February 2024. So this 56 lakh, we have to tax it under IFOS, and they have given, sir, 40 lakhs. So that has been distributed. Both dividend received and paid were credited and debited respectively in the consolidated statement of P&L account. So whatever dividend we have received is our income, should be taxed under IFRS, and we can claim ATM Chapter 6A deduction. So this is what 3 crore 94 lakh 95,000, because the interest income will not be taxable. So income from other source, dividend income from ABC, a foreign company, 56 lakhs. So the gross total income is 4 crore 50 lakh 95,000. Less deduction under ATM in respect of inter-corporate dividend to the extent of dividend distributed by it before 1 month prior to the date of filing the return, 139 subsection 1. So 40 lakh. Because they received 50 lakh, they distributed 40 lakh. So that will be eliminated from the gross total income. So the total income comes to 4 crore 10 lakh 95,000. I believe that up to this you are feeling so much comfortable. This is a very good question actually, worth for 14 mark. That's why I'm solving to help you, my dear lovable students, if you are having any particular doubt. The total turnover of company for previous year 21-22. Look, what is our financial year? 23-24. What is the immediately preceding previous year? Sir, 22-23. What is the Immediate to immediate preceding previous year, financial year 21-22. I want the turnover of financial year 21-22. I will not see immediately preceding previous year. Immediate to immediately preceding previous year was 390 crores. That means less than 400 crores. That means the company is a small company. They are liable to pay tax only at the rate of 25%. And for financial year 22-23, 405 crores, put it on dustbin. That is irrelevant data just to confuse us. Company has a MAT credit of 20 lakh of assessment year 15-16. Book profit computed for the assessment year 24-25 is by 20 lakhs. Oh my God. They themselves given the MAT part. They themselves calculated the book profit. Just we have to apply 15% plus surcharge if applicable. Kandipa. Compute the total income of company and optimum income tax liability for the assessment year 24-25. Assume company have not yet opted for concessional tax regime. Not yet opted. Your answer must give reason for treatment of each item given above and also for the tax liability. This part only, this line only motivated me to solve this question, my dear lovable students, because it's a beautiful analysis they are making. Nearly 3 routes we have to work out and say what is beneficial to the company. Brilliant question actually. Computation of tax liability under the regular provisions of the Act. Now, I am traveling through the regular provisions of the Act and don't confuse with 115 BAC and all, because 115 BAC is applicable to individual HUF, AOP, BOI, AJP. This is a company we are talking about. So, we have to put normal provisions, we have to put MAT route or concessional rate, right? Like 115 BAA or 115 BAB. Tax liability of 4 crore 10 lakh 95,000 at the rate of 25%. Since the turnover of company for the previous year 21-22 does not exceed 400 crores. So you take your calculator, 4 crore 10 lakh 95,000 into 25% comes to 1 crore 2 lakh 73,750. Is the company's total income exceeds 1 crore? Yes, surcharge will be applicable. COMPANY, company means 7. Letters are there, that's why surcharge at the rate of 7%. Partnership firm 12% interest, 12% surcharge. So surcharge at 7% since the total income of company is more than 1 crore but up to 10 crore. So on this amount you have to put 7%. So 7,19,163 you will be getting subtotal. Add health and education cess at the rate of 4%, you will get the total tax liability, my dear lovable students. This is the tax payable as per the normal route. Don't stop with this. Because for company, provisions of 115 JB will be applicable. We have to find out the book profit, but with God's grace, they themselves given the book profit. Otherwise also, we have done a detailed discussion of computation of book profit. Let them ask. MAT at the rate of 15%, sir, on book profit of 5 crore 20 lakhs. Why 15%? Because this is not AMT. AMT is 18.5%. MAT is 15%. So 5 crore 20 lakhs. Into 15% comes to 78 lakh. Add again surcharge at the rate of 7% because the book profit is more than 1 crore up to 10 crore. So my dear lovable students, into 107% comes to 83 lakh 46,000. Into health and education cess of 4%, tax liability under section 115 JB is 86 lakhs, sir, 79,840. But the total income tax payable comes to 1 crore and odd. So the total income tax payable is more. So since the regular income tax liability is more than the minimum alternate tax liability, she the limited is liable to pay tax under the normal provisions of the Act. So I have compared normal route with the MAT route. Brilliant. Now the normal route is higher. I will travel through the normal route. Tax liability under the regular provisions of Income Tax Act. So 1 crore 14 lakh 32,630. And we are having MAT credit. We know that. Entire MAT we cannot set it off. We have discussed this in class. Only the difference between the tax payable as per the normal route and tax payable as per the MAT route, that difference can be set it off. Clear? So how much is the total MAT credit we are having, my dear lovable students? Sir, the company has a MAT credit of 20 lakhs. You look at the difference. We are having 1 crore 14 lakh 32,630 is the tax payable as per the normal route, but 86 lakh 79,840. So 1 crore 14 lakh 32,630 minus 86 lakh 79,840 comes to, sir, up to 27 lakh 52,790. Up to this amount we can knock off. But we are having only MAT credit of 20 lakh. That's why full 20 lakhs we are reducing. Oh fine. I have not noted this point, sir. Good point. Right. So the net tax liability comes to 94 lakh 32,630. 94 lakh 32,630. So I have calculated the tax payable as per the normal route, and I have calculated the tax payable as per the MAT route. Normal route was higher. They were having MAT credit. I have knocked it off that MAT credit. Look at the knowledge. Fantastic to the core. Everything we have discussed in class. Nothing we have missed. So I am checking whether it is beneficial for the company to adopt concessional rate of tax. This part only I love the most in the question. Shidal Limited is eligible for concessional rate under 115 BAA, not BAB, 115 BAA. At the rate of 25.168%. How 26? That is tax at the rate of 22%. Plus surcharge mandatory at 10%, plus health and education cess at 4%. Subject to tax at the rate mentioned in the said section in chapter 12. Subject to tax means 112, 112A, 111A. In case Shidal Limited opted for concessional rate of tax under 115 BA, it would not be eligible for deduction under 35AD because nearly 8 to 10 deduction the company is not entitled for. So I have to rework the total income whatever I have worked in respect of fertilizer producing unit. However, it can claim depreciation under section 32 on building and plant and machinery. Normal 32 depreciation is allowed, but additional depreciation is not allowed. In that case, its total income under 115 BA would be there will be small change. Profit from chemical manufacturing unit Jaipur, no change, because from Jaipur we have already calculated the first one, chemical manufacturing. We got the profit of 3 crore 14 lakh 20,000. The same 3 crore 14 lakh 20,000 even under the concessional route, because I have not claimed anything which are not allowed under 115 BAA 5. Profit from furniture manufacturing unit Pune. There is no change in the furniture manufacturing unit Pune. Even for that 1 crore 15 lakh 75,000. Yes, 1 crore 15 lakh 75,000. But with regard to profit from fertilizer unit Narmada, they were 35 AD. So they would have claimed 100% deduction. That is not allowed. So we have to calculate as if no, that deduction is allowed. So fertilizer net profit was 2 crore 20 lakh. Sir, depreciation we have added back. My dear lovable students, items debited but to be disallowed or treated separately, by saying that we have added back depreciation on building 25 and 45 lakhs. After adding that depreciation, we have find out 2 crore 90 lakhs. Then we have claimed 100% deduction. This 100% deduction under 35 AD is not allowable under the 115 BAA route. Now you are having the moral responsibility to go back and revise 115 BAA. And you should have, this is how you have to prepare for your examination. All the connected things, if you are studying, then revising, then it will be very easy, man. So after adding back that, we have reduced this and we have end up with a loss of 2 crore 60 lakh. So we have to rework that. So what is the profit given? 2 crore 20 lakhs. On that 2 crore 20 lakhs, sir, they have already reduced the depreciation. So what is the 115 BAA? 2 crore 20 lakhs, because that 2 crore 20 lakh itself is already after reduction of the depreciation. Okay, sir. So profit from warehousing for storage of edible oil at Delhi, we already calculated it become a loss 35 lakh, and that loss of 35 lakh is normally allowed. So 35 lakh, once I knock off, I will get the, sir, PGBP income 3 crore 40 lakh 20,000 plus 1 crore 15 lakh 75,000 plus 2 crore 20 lakhs plus minus loss of 35 lakh. Sir, 6 crore 14 lakh 95,000 is my PGBP income. I am having dividend from foreign company, should be taxable under IFRS 56 lakhs, no problem. I will be getting gross total income of 6 crore 70 lakh 95,000. Yes. Sir, I can claim under 115 BAA 80M deduction, 80JJ AA deduction. Yes, less deduction under 80M in respect of inter-corporate dividend to the extent of dividend distributed by 1 month prior to the date of return of income under 139(1), which comes to 40 lakhs, my dear lovable students. So the total income will be 6 crore 30 lakh 95,000. On that 115 BAA, how many A? 2A, so 22%, 2 A, 2 letters are there. So 22. Plus mandatory surcharge of 10%, health and education cess of 4%, 25.168% flat. Sir, once you travel through 115 BAA route, the provisions of 115 JB will not be applicable. So it stands in the shoes of the normal route. So no need to compare that with the MAT. So my tax liability is this much. Suggestion to Sheetal, inga paru 1 crore 58 lakhs worth. But normal route I have to pay only 94 lakhs after MAT credit. And once I travel through 115 BAA, this MAT also I have to forgot. I have to put it on dustbin. That is a consequences of 115 BAA. So Sheetal Limited should not opt for 115 BAA for the assessment year 24-25 because at any time you can enter into that section, right? Since the tax liability under 115 BAA is higher under the regular provisions of the Act and section 115 JB, so 3 routes we have calculated. How many minor things we have to look for it? Normal route, we are well versed with it. 115 JB, we are the heroes in that. 115 BAA, sir, there we have discussed in the class and we have done this question. My dear lovable students, my suggestion to you at this point of time is, if you listen to this lecture, don't just leave it by listening. Go to your book, take that question, solve it. There is a huge chance that the same question may be repeated for 14 mark in examination. And if you are feeling comfortable with the question and if you are feeling useful, share your happy comments. And you need any other question to be explained from Mock 1, Mock 2 or RTP, type it as comment. I am here to help you, my dear lovable students. And my happiness is all this have been discussed in the class. Normal route, MAT route and 115 BAA concessional rate of tax. From there 14 mark means that has to be secured. In exam they may ask only normal 414, only MAT 414 or 115 BAA part also. All the 3 we are ready now. Happily prepare for your examination. If you are feeling comfortable, just put your share as your happiness. Will be here to help you. Till that, thank you and bye bye from ANM.